Hello and welcome to episode number 2 of Masterclass with Utpal Sheth. The first episode, and it was episode which personally for all of us has been an eye-opener, that how long-term wealth can be created by two simple pillars: time, which is patience or horizon, and terminal value investing, which is where you identify the true potential of a country or a company or of a business. But in this episode, we would get into the whole process of terminal value investing. We've introduced the concept, what it means, and what a powerful concept it is. And now we'll take it slightly further. But before I start the show, I just want to thank you on behalf of our viewers that you've been very charitable with your time. The fact that you're sharing, which a lot of investors don't like to share, it really means a lot to us. And more than anyone else, you know, people in the studio, people outside the studio, and people in my office are really excited to know more about terminal value investing. We've introduced to our viewers the whole concept of terminal value investing and the importance of time. Now let's take it forward. Normally as an anchor, I ask questions, but I'll keep it open. How do you want to start with?
Okay. Thank you, Nikunj. And it's actually my privilege to be here with you and share my learnings. I hope it helps investors. Terminal value investing is a very powerful concept in my mind. And let me start with a very elementary process. The investment process has three distinct components: buy, hold, and sell. This is known to everybody. However, bear in mind that when you buy, you are buying, as we have discussed in the previous episode, at time t0, at the price prevailing at time t0. In terminal value investing, you are buying at time t0 at the current market price, keeping in mind the terminal value as you see it at time t10, which is 10 years from now. However, what do you need to buy? Some may say you need a tip to buy, but that tip is not terminal value. So you need something else. The act of buying means that you have to be a willing and an able buyer, which is all right in the context of consumption, but not in the context of investing. In the context of investing, to buy, you need to have conviction and courage. I'm sure you are aware of this book called 100 Baggers by, I think, Thomas Phelps, who says you have to have the vision to see, the courage to buy, and the patience to hold, with patience being the toughest one. We are building on top of that framework here. This conviction and courage that we talked about, that you need to buy, are very important. Sometimes you are able to build the conviction but not the courage, in which case either you will not buy or you will not buy enough. Sometimes you don't have the conviction and you will still buy, which means then that you will be thrown off at the first sign of volatility, because you are buying without conviction. So you need both conviction and courage to be able to buy. After having bought, given that you have a 10-year plus time horizon, you have this long journey of hold. What is it that you need to hold? Again, I would say that you need not just patience, you also need equanimity. to hold. Equanimity is a state of mind, and that state of mind, if that gets disturbed, then you will not be able to hold, even though you may have patience. And you can have all the equanimity in the world, but if you don't have patience, you will not be able to hold. However, you will find usually that those who have equanimity also have patience, and therefore the ability to hold for long works. However, this patience and this equanimity has to sit on top of the courage and the conviction that you had in the first place to buy. And during that journey, you will have many ups and downs, many macro events, many micro challenges. During that time, you have to keep revisiting your conviction. You have to keep reassessing your hypothesis, revalidating your hypothesis. And all this while, that terminal value is not constant. It will keep evolving, right? You have to be vigilant that that terminal value is evolving favorably rather than adversely.
Okay. तो ले लिया, रख लिया, अब क्या करना चाहिए?
Right. But here again I will quote Rakesh ji. He used to say, या तो सट्टा मत करो या तो अफसोस मत करो. If I may take the liberty of paraphrasing Rakesh ji here, I would say that या तो इन्वेस्ट मत करो या तो अफसोस मत करो. So the sell decision is important. It's a very rare decision that a terminal value investor will take, but it may need to be taken at the right time. Usually, a sell decision by a terminal value investor would be only when the hypothesis on the basis of which that terminal value framework was built breaks down. There may be some fundamental change that is happening and which breaks that hypothesis. They are very few and far in between, and that's the reason that the average duration of a terminal value investors holding a particular stock would be very long, at least 10 years. Now, this sell decision, apart from breaking of the hypothesis, could also be for a few other reasons which are also very rare. One is where you may find that the relative opportunity of terminal value shifts is far greater somewhere else. In which case, given that none of us has infinite money, you may switch. But again, this is very few and far in between. It is only when you find that you are constrained, that you don't have adequate capital, and that capital you need to allocate to a terminal value shift which is far bigger and better, then you may do so. And the last, and also again very rare, is where you feel that there is insanity in valuations. But let me give you a caveat here. There may be insanity in valuations, and those insane valuations may correct at some point of time. But you must assess before selling whether or not you will be able to buy it back. Don't assume that you will be able to buy it back. What I have found most frequently is that when you do decide to sell terminal value on the basis of insane valuations, the momentum still keeps going, and then maybe it corrects sometime later, but you fail to be able to buy back at that time. So I would really suggest that you look deep into yourself before you take that sell decision. These are the three components of investing, which is buy, hold and sell.
You've really put it very simply. Buy, hold, and sell. Buying is the most important thing. Courage and conviction. How does one go about developing conviction and then courage both? Because they both are an interplay. For you, when you are a terminal value investor, what is the starting point for you to start developing conviction? Is it a P multiple? Is it an enterprise value? What is the starting point for you?
See, the root cause of that conviction and courage has to be what I call as a differentiated insight. What does differentiated insight mean? And why is differentiated insight the root cause of conviction and courage? See, we are living in an era where information is surplus. So we don't have to try and find more information. However, it's not just sifting of information, not just analysis, but also synthesis of everything. So I would submit here that differentiated insight is the root cause of the conviction and the courage. There is this fabled private sector bank which has been a star performer for many, many years, which has not performed that well in the recent 2-3 years. However, during all this time, it was perceived as the most expensive bank in India. And at one point of time, it was quoting at the highest multiple of any bank anywhere in the world. So, was it insane valuation? That would be the question in the mind of the terminal value investor here. My submission would be that for somebody who had understood that bank well, and I should be the first to admit that I did not understand it very early in the process, that investor should have the ability to see that this was a truly retail bank. So retail consumption was the mega trend here, so to say, and this bank was a leader participating in that mega trend. And hence, instead of thinking of it as the most expensive bank in the world or in India, one had to compare it as probably the cheapest consumption proxy in India. And with that one tweak in your mind,
it was not a bank, but it was a consumer brand.
It was a consumer proxy. Consumption proxy.
Yeah, consumption proxy.
Right?
Okay.
And it was a leader and it was participating in that mega trend, and it was not as expensive as the consumption stocks that were available. Right? This is just one example of how differentiated insight works. So there was no superior information here.
Courage. Now, courage is a function of risk. Courage is a function of availability of capital. In a market like India, which is in a bull market, courage has always worked. For example, Rare has been known for buying at turning points after 9/11, after 2008, during the COVID crisis. How would you define courage? Is it buying when everybody else is selling?
See, buying when everyone else is selling is a contrarian position, and that also requires courage. But here we are talking of courage in the context of conviction. Okay? And let me put it this way, that the source of this courage is not just the availability of capital. Because as a small investor, probably, for me to invest my 1 lakh rupees also requires as much courage as somebody will need to invest 100 crores or 1000 crores depending on their size. You have to trust your conviction and have the courage that whatever is the reason that the seller is selling does not compromise my differentiated insight, and I believe enough in my differentiated insight to risk my capital. I am fine to deal with market volatility and look through any price correction that I may have to face. The current valuations do not worry me enough to suppress my courage. My courage has to overcome the valuation conundrum. My courage has to overcome the macro anxiety.
They say wealth is created not in buying or selling, it is created in your ability to hold. And that is the most difficult part, because markets are dynamic, prices they change, there is a lot of volatility, there are global events. Every 10 years you have some event or the other where market collapses by 40 to 50%. How does one really get the conviction to hold, which is the most difficult part?
Yes. Nikunj, to hold, you do not only need conviction, but as I said, you also need your patience and equanimity to sit on top of that conviction. And just like conviction, the root cause of conviction is differentiated insights. In the same way, the root cause of your patience and equanimity also has to be your differentiated insight. Now, the parabolic impact of compounding in general, which led Einstein to say that compounding is the eighth wonder of the world. Those who understand earn it, right? So, the parabolic impact of compounding leads to outsized returns in the later years. But why does that happen? And here I will take back to the quote that we used in the earlier episode of Eric Smith, which says that we end up overestimating the short term but underestimating the long run. Now, for an investor to hold for long, he has to believe in each of those components, right, and not be thrown off by macro volatility or maybe performance anxiety. Those have to be eliminated. You have to be able to look through that. And I think you will agree with me, Nikunj, that today the way domestic capital and Indian retail investors are behaving, they seem to be looking through almost any and every challenge. The conviction of that domestic capital that I am seeing today is better than I have ever seen it in all my career.
How does a terminal value investor keep holding on and sticking on to the template when there are factors which can purely change the entire construct of the company, construct of the environment, and the sheer value of terminal value, which could be a function of interest rates and other macro factors? How does one really justify thesis when the environment is so rapidly changing? For example, COVID, 2008 crisis, demonetization.
Sure. The first question that a terminal value investor will ask in such situations is whether that immediate event or proximate event is structural and secular. If it is not structural and secular, then one will not give it that weight. The second question that this terminal value investor has to ask is whether the management team in which he or she has conviction, whether that management team is adaptable enough and agile enough to navigate the proximate challenge, right, or the proximate event. If the answer to the second question is that he or she has that confidence in that management team, then really speaking, all such adversities actually turn into opportunities for that company in which you have invested rather than being an adversity.
For example, when demonetization happened, everyone thought that companies would suffer permanently, but it was pure migration of the cash economy to digital economy, which led to a sell-off in 2016. In hindsight, it turned out to be a great time to invest.
Not only was it a great time to invest, but it put in motion a structural trend of a shift from unorganized sector to organized sector at a nationwide level, which changes the industry dynamics of every sector.
A lot of, again, marquee investors have a different philosophy when they sell. Some have gone on record and they've said that we want to be a permanent owner. Buffett has also said this, that we like to be a permanent owner of the companies. For a terminal value investor, the decision to sell is also important. Ghar mein paisa aana chahiye. How do you decide when to sell and what is the right time to sell?
So your sell decision is not dependent on time. Let me make that very clear. It's not dependent on your view on the macro. I mean, for a terminal value investor. Okay. Your sell decision, as I have explained before, is linked to whether your hypothesis, investment hypothesis, is broken. If it breaks, then really you don't have a choice. Okay? However, you will face occasions where it is not broken, but it is compromised for a period of a few years. Okay? At that point of time, using your conviction in the terminal value, if the price correction is dramatic, you may choose to end. But if the price correction is not dramatic, then you may choose to reduce the concentration of that company in your portfolio, leveraging what we call as probabilistic portfolio management.
What is that?
That while the absolute terminal value is important in your mind, the probability of that terminal value is equally important. And if you remember, we talked about probability earlier.
Yes.
So whenever that probability is severely compromised for a 3-year or more time frame, then at that point of time, you may choose to reduce the weight of that company in your portfolio. If the company misses a quarter, that is no reason to reduce weight or to sell. But if there is a structural change which will hamper that company for 3 years or more, then I think there is cause to reduce weight. That reduction of weight also creates an opportunity for you. And what is that opportunity? The opportunity to come back with force in the event of a severe price correction. Just because of the near term challenges, right? But I would not advocate selling because of those, because of that terminal value probability getting compromised for 3 years or more, because then you may not be able to re-enter when the time comes.
So a sneak peek to our next episode where we would be talking about factors or the pillars which in a sense really a terminal value investor uses. But I have a simple follow-up question, which is that the world we are in today is a very disruptive world. 3 years, market leaders, they change, technology is changing everything. I look at a company like Reliance, what it was, start with only Vimal, today it's a diversified company. Company like Titan, it started as a watch company, today it has got very different models. Food delivery companies, Amount. I'm using that for reference for our viewers here. How does a terminal value investor go about keeping the faith and not the decision to sell when you invested with an original thesis has changed, but the company has also evolved? That was not part of your original terminal value calculation, but the new business is so great that the terminal value needs to be evaluated. And that is happening in abundance now.
True. See, your original investment hypothesis is not about a static business model or a static management team. It is about a dynamic management team. It is about the culture of that company, the capabilities of that company, right? Their ability to adapt and evolve, their agility, right? And whether they can pivot or not, whether they can navigate challenges or not. You will make all of those assessments as part of the terminal value assessments.
Before I wrap the show, I just want to summarize. What we've identified in the first episode is concept of terminal value. Now the whole process of terminal value, simple: buy, sell and hold. Now in the third episode, what are we likely to discuss? Why don't you give me a teaser?
Okay. What we will dig into in the next episode is what are the components of differentiated insights.
Well, we've not recorded the show, but I can share with the viewers, the listeners and the audience here is the differentiated insights. I'm excited to really understand those differentiated insights, and I'm sure you are. So stay tuned for the third episode of Terminal Value Investing, Subpara Differentiated Insights.
If you like this video, then like, share and subscribe to ET Now.